Welcome to our deep dive on the mortgage versus cash decision for a high-value home purchase. Today we will focus on a $750,000 example at a 6% mortgage rate, and we will analyze not only interest but also taxes, liquidity, and long-term financial security. We will examine when strategic debt can win and when paying cash makes the most sense. Finally, we will give you a practical framework and quizzes to test your understanding. Let's begin, and then we will move into our agenda. Here is our agenda. First, we will set the stage for high-income earners near retirement making a $750,000 home purchase decision. Next, we will explore the controversial insight that you should not rush to pay cash. Then, we will discuss why strategic debt can win, followed by a simple framework and a quick numerical example. After that, we will cover when paying cash does make sense and compare pros and cons side by side. We will also include interactive quizzes and finish with key takeaways and an important disclaimer. For high earners around age 50, purchasing a $750,000 home at a 6% mortgage rate is more than a simple payment decision. It affects immediate taxes, capital allocation, liquidity for emergencies, and your retirement trajectory. Therefore, the right choice must balance cost, risk, and flexibility. With that context, let's transition to a controversial insight that often surprises buyers. The most significant pitfall of paying cash is the immediate capital gains tax liability from liquidating investments. The federal long-term capital gains tax is commonly in the 15 to 20% range, and there may be an additional net investment income tax and state income taxes depending on your situation. Consequently, while you might avoid paying 6% mortgage interest, you could be giving up a larger amount right away to taxes. Therefore, always calculate the tax cost of selling versus the effective after-tax cost of borrowing. Next, we will expand on why strategic debt can often be the better path. First, liquidity and safety. Cash tied up in home equity is hard to access. Maintaining investments by using a mortgage keeps your resources available for unexpected events, market volatility, or income disruptions. Second, return arbitrage. Diversified portfolios have historically returned around 8 to 10% if your loan costs 6% before tax and potentially less after tax due to itemized deductions. Your invested capital could out-earn the borrowing cost over time. Third, taxes. Mortgage interest may be deductible if you itemize, which can reduce the effective cost of the debt, subject to IRS limits, and your personal tax profile. Finally, if you dislike debt, you can still avoid triggering a large capital gains event today by taking the loan and then prepaying principal once it is optimal. Now let's move to a practical step-by-step framework. Begin by estimating your capital gains exposure if you sell investments to pay cash, including federal, possible net investment income tax, and state taxes. Next, compute your annual mortgage interest cost at the quoted rate and across your expected holding period. Then, adjust the cost for any actual tax benefits you receive if you itemize deductions, bearing in mind standard deduction thresholds and interest deduction limitations. After that, estimate your expected portfolio return range and consider volatility. Subsequently, run scenarios to stress test your plan under adverse conditions such as market downturns, employment changes, or large expenses. Finally, choose a path and establish clear rules for prepayment, portfolio rebalancing, and maintaining sufficient emergency reserves. In the next section, we will walk through a quick, simplified numeric example. This is a simplified, illustrative example, not advice. For the mortgage route, assume borrowing $600,000 with 20% down at 6% interest, and assume the taxpayer itemizes at a 24% marginal rate. Year 1 interest would be roughly $36,000. And the after-tax cost could be approximately $27,360 if an itemized deduction is available. Meanwhile, $600,000 remains invested. At an 8% hypothetical return, that would be $48,000 of growth, recognizing that returns are uncertain. For the cash route, assume selling $750,000 of investments with a cost basis of $450,000, generating $300,000 of gains, and approximately $45,000 of federal long-term capital gains tax at 15%, excluding any additional surtaxes or state taxes. With cash, interest cost is zero, but liquidity is reduced and investment growth on that capital is foregone. Now let's discuss when paying cash can still be the right move. Paying cash can be best when you prioritize certainty and simplicity. The implicit return from avoiding a 6% interest rate is guaranteed and risk-free in nominal terms. It is also compelling if your retirement is already fully funded and you maintain sufficient liquid reserves elsewhere. Another favorable case is when selling investments produces minimal capital gains due to high cost basis or available tax offsets, which a qualified CPA should confirm. Finally, if you strongly value being debt-free and avoiding administrative complexity, paying cash can be the right decision. Next, let's compare pros and cons side by side. On the mortgage side, you preserve liquidity and optionality, may receive an interest deduction if you itemize, and could benefit from a return spread if your portfolio outperforms the loan's effective cost. You also retain flexibility to prepay principal. However, mortgages add closing costs and complexity. On the cash side, there is no interest cost, and many people appreciate the simplicity and psychological freedom. Payment risk is lower because there is no required loan payment. However, you might incur a large initial tax bill if you liquidate appreciated assets, and you give up the opportunity for those investments to keep compounding. With that in mind, let's visualize the trade-offs with another diagram. This pie chart is illustrative. Under a cash route, most of your net worth shifts into home equity with lower liquidity and some taxes paid up front. Under a mortgage route, more remains in investments, with a smaller portion in home equity initially and some closing costs. The exact distribution will vary significantly based on down payment size, current tax law, your cost basis, and your marginal tax rates. Next, let's test your understanding with a quick quiz. Quiz time. The question is, which factor is most often overlooked when paying all cash for a home? Option A, immediate capital gains tax from liquidating investments. Option B, the color of the front door. Option C, the homeowners association meeting schedule. Option D, which moving company to pick. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is immediate capital gains tax from liquidating investments. This tax can be a large immediate cost that diminishes the benefit of avoiding mortgage interest. Always evaluate the tax impact before selling appreciated assets. Now let's try a second question to reinforce the return comparison. Here is the second question. If your expected portfolio return is 8% and your mortgage rate is 6%, and after accounting for deductions your effective mortgage cost is approximately 4.6%, what is the rough expected spread? Option A, about 3.4% in your favor. Option B, about 1.4% against you. Option C, exactly 0%. Option D, over 10% in your favor. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is about 3.4% in your favor. We subtract the estimated effective borrowing cost of approximately 4.6% from the expected portfolio return of 8% to arrive at an approximate spread of 3.4%. This spread is uncertain and not guaranteed, but it illustrates how strategic debt can potentially enhance outcomes. Next, we will recap the most important takeaways. The key takeaways are as follows. Compare the immediate tax cost of selling investments to the after-tax cost of borrowing. Protect your liquidity and avoid exhausting necessary retirement assets to fund home equity. Consider expected portfolio returns relative to the effective mortgage cost. If you are debt-averse, you can still avoid a large tax event by taking the loan and prepaying principal strategically. Pay cash when liquidation taxes are minimal and your retirement is fully secured. Finally, document your assumptions, run multiple scenarios, and consult qualified professionals. This mind map organizes the decision space. At the center is the home purchase decision. One branch is the mortgage path, which emphasizes preserved liquidity, potential tax deductions if itemizing, the possibility of a positive return spread compared with expected portfolio returns, and the option to prepay principal. It also includes risks such as interest rate changes and market underperformance. The other branch is the cash path, which removes interest cost and simplifies finances but reduces liquidity and may create an immediate capital gains tax if you sell investments, alongside the opportunity cost of foregone investment returns. A third branch captures external factors including age, retirement funding status, emergency reserves, and state taxes that can materially influence the decision. Next, we will summarize and then provide a critical disclaimer. In summary, this choice extends far beyond the 6% rate. It is fundamentally about taxes, liquidity, and long-term flexibility. Strategic debt may win when expected portfolio returns exceed your effective mortgage cost, and you need or value liquidity. Cash can be best when your capital gains taxes are minimal, your retirement is secure, and you prioritize simplicity. Before taking action, run the numbers. Stress test your assumptions, and seek professional guidance. Finally, let us add an important disclaimer. This content is for educational purposes only and does not constitute tax, legal, or investment advice. Your circumstances are unique, and tax laws and deductions can change. The examples here are simplified and may omit important considerations such as fees, state taxes, alternative minimum tax, the net investment income tax, deduction phase-outs, or lending constraints. You should consult a qualified certified public accountant, financial planner, and mortgage professional before making any financial decisions. With that, let's close out with our final message. Thank you for watching. If this video helped you, please like, share, and subscribe for more deep dives. Tell us about your own scenario and assumptions in the comments so we can explore more real-world cases in future videos.